The following podcast is produced by Total Money Management AFSL 568642. Everything you're about to hear is general information and education only. It does not take into account your personal objectives, financial situation, or needs, and it is not financial advice. Before being a silly sausage and acting on anything discussed, consider whether it's right for your circumstances and speak to a licensed advisor.
Welcome back to Total Money Management, the Signal and Noise podcast, week ending the 7th of August.
Tom's
There you
back.
go.
It's actually frightening that it's August already.
I know.
I know, it's crazy, isn't it? Eka next week.
Yeah.
Is it?
I know.
Yeah,
I'll be staying far away.
You're going to get
Yeah,
your Bernie
Brisbane-
Beetle show bag?
It kicks off
probably
next
$90
Kicks
now.
off next Friday, and then there's a public holiday on the Wednesday after that.
Okay, that's
Yeah.
good. I'm
Yeah.
in a different. I'm different up in the sunny near Kenilworth in the sunny coast. Mine's a different day.
Yeah, it will be.
Noosa or something like that.
Yeah. I think Ipswich gets the Tuesday off or something, right? Okay. Something like that. But I think I'm a little bit old for the Eka these days.
You're not
There you
going.
go.
Every year I go, the cows still look the same. There's no change or anything.
Well, before we forget, we have a special announcement.
Oh, a special announcement.
Happy birthday, Mark.
Happy birthday, Mark.
You know who you are.
For the 14th of August.
14th is his birthday. Apparently, Mark was our first and biggest number one listener,
Right. Who we've never heard from.
who we've never heard from.
Yeah, write to us. And we're so grateful. And if your name's Mark and it's also on the 14th, we're also talking to you.
Yeah.
Stop getting
So
Jen to do
happy
things for you.
birthday, Mark.
Yeah.
Here's your shout out. We don't know what your last name is. We don't know where you live.
Oh,
We don't even know how old you are. You could be 85 for all we know. But anyway, happy birthday.
I also have to give a shout out to the King, King Lear. He knows who he is. He
King-
listens to every episode.
Who does? King?
King Lear. It's all right. He knows.
Is that a
Oh,
personal
okay.
That's all. It's a
All
real
right.
person.
That's a
Yeah.
bit of a side swipe there.
Where's he?
Royalty.
Right. I thought you were talking about King Leo.
No,
Leopold.
but we could talk about him too.
Leopold.
Yeah,
Put a
we're going to
segment
get
on
to
Leopold.
that when we start talking about situational awareness.
Indeed, we will. Indeed, we will. But let's talk about our favourite subject, war and oil.
Wait.
Yes.
It's been a while.
It's been a while. That's
It's
true.
been a while
John.
for those that don't come every week.
We had a special last
Yeah,
week, so it's been 2 weeks.
It's been 2 weeks for
Right?
me.
And since then, oil's doubled and halved, and then tripled and halved again. So I still can't work out how it's so cheap.
Jacob and Elle go from caviar to noodles.
Yeah, I'm on the noodles this week. Well, I made the mistake of checking it yesterday.
Oil.
Yes, and it was down 7% or 8%. Mine in one day, and I was like, oh Jesus.
Yeah, times 2.
Oh, you
for
don't
the
worry
leverage.
about that. Remember, mate, volatility clusters.
Why didn't I just check the day before when it was up 8%? And I would have been happy.
Yeah. But my local servo, the prices jump. Oh, that's because of the federal government thing, right? Okay, because I was thinking, God, it's gone up like 25 cents, but that's because the
excise.
the government took the excise off. Okay,
Yeah, and your best mate Chalmers said they weren't considering adding it back on either.
No, not at all. But anyway, the story is now, and it seems to be firming, that Trump has had enough and wants a deal.
Yeah. How many bombs has he?
Sorry?
How many strikes?
Well,
has he
part
issued
of it
this
is
week?
it's a bit like they've run out of weapons. Again, a rumour was that last week he blew up at, it's an apt metaphor, isn't it? He blew up at Hegseth, the Department of War, the secretary, because he said Hegseth didn't tell him that they were short of weapons, or, they were running them down. So anyway, so there's that. The story is Trump wants a deal. Iran is saying they're going to charge 7% per tanker load to get out of the strait, although it won't apply to China and Russia.
Hang on.
That's got to be a blue.
They're going to charge what? 7%?
They want to charge 7% per tanker, which
7% of what?
the load,
Oh.
the value.
And they'll get them through safely.
Yeah, so
Oh.
it's basically like a mafia move, right?
Yeah. So how many
It's
ships?
protection money, and it will make them about 130 million a day. So, about 750 a week, which is not too shabby.
That will pay for Trump's son's hedge fund or crypto fund.
Yeah. So, So there's that side of it. Apparently Oman is thinking 5%, and of course the Yanks have said no, there shouldn't be anything on it. But I just keep looking at it going, I don't know how this is going to work, because it just looks like it's really, really bad.
Well, only 2 ships got through today.
Yeah,
He's the guy with the tracker now.
the Hormuz tracker.
Only 2.
So, but in all seriousness, I think if they get an agreement, I think you'll see a further drop in the oil price, right? So you'll see, if you're watching Woodside, it's going up and down as the oil price goes up and down.
Yeah.
Right? Yeah. Lots of stocks are. So I expect you'll get a short-term drop, but the longer-term issue is...
Well, it's still there.
Well, it's still there, Tom, but the longer-term issue is all of these countries are going to say, right, that's it. We're going total EVs, batteries and stuff, which has got its own problems with rare earths and stuff. But that point aside, it's not that easy to the Hormuz does about 22 million barrels a day, right? It's not that easy we'll just go around, we'll just go to the other side of the Red Sea and get it. It's like, it's not that easy. The other issue to consider is too that there are elements within the IRGC, which is the Iranian Revolutionary Guard Corps, which is basically the military. There's a large faction in there that are intent on not having any agreement, right? So the problem will be in the future, these guys might bomb a ship, or they'll threaten it, or there'll be a tweet, where the oil price will fluctuate a lot based on the rumours and stuff coming out, right? Yeah. So it's a really messy situation. It just looks like an absolute disaster.
Yeah, I don't know. Like, I think for me, I've stopped watching the news every day or two because it doesn't matter. Like, I've actually lost trust in what anyone's saying.
Yeah.
And it's all, it's ironic. Noise. Well, that's what I mean. It's ironic that we're signals and noise. But even we're falling into the trap sometimes of going, well, this and then that and then this.
Yeah, but we did say, Jacob, that the problem, like you're highlighting, is there's so much uncertainty about that we can, it's no good us saying one week, it's all good, and then the next week it goes pear-shaped again. No. So it's one of those things where you have to look at it and just ride it and sort of go, okay, I'm just going to monitor it, but I'm not going to do, if you believe oil's got a long-term future, either way, well, you buy oil stocks and you sit back and let things rip, right?
Yeah.
If you're a short-term trader, that's where it makes it really hard because, like you say, you can wake up and go, my portfolio, I've lost 8%.
News article.
Right. So that's what I mean. It's really, really hard. I just can't understand how Russia's been fighting Ukraine. Admittedly, it's at a different intensity.
Like 4 years.
For 4 years, and yet the Yanks reckon they've run out of Patriots or near run out of Patriots after 4 months.
Yeah.
And it's got a budget that's like, it's twice the size of the rest of the world all put together.
It's all a marketing scam. It's all, in my opinion, it's there to just generate noise around a global, trying to get a global restructure, as we've spoken about.
Yep.
And it's on and it's off, and that is to keep the media on it. If it was always on, like Ukraine and Russia, the media leaves after 3 months and goes find the next shiny object. But if it's always on and it's always off and it's always on and it's always off, then they don't know. It keeps it in the front of people's mind without going down the conspiracy rabbit hole. But it's true. Like if it was always on and just we're going to bomb them until there's nothing left, then tell me when it's finished.
Yeah. I think part of the problem, and we'll probably talk about this later in private credit, the problem I have today is that it seems like there's two things going on. First thing is everybody's speculating, right? And we've talked about that before. The second thing I think is that the problem is the incentive structure today for everybody is to act in their own interests rather than act in the interests of their clients or their customers.
Yeah.
Right? And so the media is now not interested in actually conveying the truth. It's just interested in getting you to click. I don't know, like I go on Facebook, right, and I'm through my feed, and there's stuff about the Broncos Football Club, right? And I think,
Still reading that, eh?
yeah, I read a headline that's like, Broncos superstar set to leave, and I think, Jesus, so I click on the article, and of course, it's some garbage, right, from 6 months ago or something, and it's sort of like, you bastards, you just wanted me to click. So now what I do, and what I've learnt is, you click on the art, you click on the picture, and then you go to the comments, and there's one guy that says, it's about Ben Haas, saved you a click, right? So, but my point being, and this is the thing that you get in finance, like everybody, I was thinking during the week, I can't recall anybody who's talking about stocks like we are from a perspective of you need to be careful, there's macro issues, it's all changing. Yeah. If you watch most of the mainstream finance stuff, it's all just the same stuff about, here's 6 undervalued stocks and, here's how you take advantage of the property crisis and any of that sort of stuff.
Well, I was going to say the same thing. I was flicking through on the way to work this morning, and everything's just a finance thing coming up, and it's literally 5 in a row. Here's 5 stocks to buy right now. Yeah. It's all AI crap. Or here's 5 stocks to sell right now. And I'm just like, how do people get suckered into this? Well, obviously, people that want to make money quickly.
Yes.
Or they've got an interest and they're just starting to get into stocks, and they're going, oh, well, this guy seems credible. He's got 50,000 followers. And
yeah.
I'll put some money in.
That's the thing about being systematic, right? It's. And I was talking to a client today, it's so important to understand those, the priming bias. They prime you to do stuff, whether it's buy or sell, they don't care so long as you're doing something.
Yeah.
And that's what I mean though. The incentive now, because I was thinking before, and I think we mentioned it a couple of weeks ago, where the Iranians said that Witkoff and Kushner, Trump's son-in-law, they're over there negotiating, right? But the Iranians are saying, yeah, but what they're doing is they're actually buying oil futures and making millions of dollars and negotiating. So they're as corrupt as bloody buggery.
Well, just to add to that, and without sticking on that point too long, have you seen this week Trump's come out and said he's bringing a subscription service?
Yeah, selling the tweets. Early 100 grand.
100 grand a month.
Hang on.
For early access.
Trump is.
Yeah, 100 grand a month for early access to Trump's literally tweets.
He'll move the market for you. So
I think they call that insider trading.
It's so outsider trading.
Yeah.
It's so illegal. And imagine these billionaires that have 100 grand's chicken feed and you make that back off one tweet.
But the funny thing is, all these billionaires in Wall Street all sitting on their bum going, I don't know why all these people are voting for socialism. Yeah. It's like, have you had a look what you blokes get up to?
I mean, just look outside the window, mate, and you might see
but it's crazy, like here I am in my, 300-foot yacht, and I can't understand why people in New York are being socialists. It's like, I'll tell you why they're being socialist, sport. It's, it's not rocket science.
I've been going down, and it's for another time, the rabbit hole of wealth inequality, but wealth inequality over thousands of years and what it's looked like, and it's fascinating that it gets to a point and just collapses.
Yeah. Well, that's what End Times is. Peter Turchin wrote a really good book called End Times, and that's what it's about. And I remember a lot of things from the book, but I remember one thing that really stood out, and it was basically like every time we've got to this point, there's been one episode in history where the wealthy have basically said, yeah, okay, yeah, no, you got a point. We'll start doing, paying more tax or whatever, right? Well, every other time, it's been a revolution.
Yeah, well, I think that time, unless there's more than that, just after the World Wars, World War I, World War II, when basically the super rich got incredibly taxed.
Yes.
Gave it all to the poor. And then there was 50, 60, 70 years worth of somewhat sustainable equality and peace.
Yeah. Jacob, it's all cycles.
Yeah.
right? But anyway, we better keep going. Crypto carnage.
Yeah.
Change.
Yeah, we're going to get to a good news story about the end.
130 mil stolen out of cold wallets. Be careful.
What's a cold wallet?
Cold storage, offline.
I'm just being
So anyway, the point being, it's a fad. This is what happens when you get fads. You get spruikers, you get theft, you get heaps of fraud. You know, it's like the property industry, right? They're building units with, half sand, half concrete, and they're falling down after 3 years and all this sort of stuff, right? And it's the same thing. Yeah. There's heaps of fraud. Look at the mortgage fraud.
private credit fraud, mortgage fraud. There's all sorts of stuff.
Absolutely.
But even on the crypto point, these things always come up at market extremes as well. Market extremes is just rife with fraud.
Yep.
And private credit's one of them, which we've spoken about a lot. And
yep,
it's just a classic. Everyone's piling in, and I think we did a special on it already.
Yeah, we somewhat did. We alluded to that. Well, we sort of highlighted issues with private credit might have been about 6 to 7 months ago.
Yeah.
But it's now starting to get more into the mainstream media, and when you have it's really bad in the US, right? It's a lot bigger in the US, go on.
Sorry, mate. I'm just coming up with things that are coming in my head. So I've not recently, but I've been playing golf with a few guys over the last few months, and that is the topic of conversation for 5 hours.
Yeah, yeah.
Which private credit are you with? Have you looked at this? Have you looked at that? It's all private credit, and it sounds kind of la-di-da, but these are people with cash,
yes,
that have liquidity to invest, and they're all talking about investing in private credit, not safe assets. Just like this is
absolutely.
Yeah, get good returns.
Yeah, but they're selling it as safe.
Well,
right.
Exactly,
and there's a really good article in the ABC. I think we put it in the podcast notes, but the problem is it's unregulated, right? And so what you're seeing is, again, it's not fraudulent behaviour, but it's dishonest, right? It's selling it off as being really not risk-free, but really low risk when it's actually not.
And a lot of people are exposed to this stuff and they don't realise it through super funds, right?
100%, Tom.
Like, this reminds me of the subprime mortgage stuff.
It is, Tom.
With the Big Short.
The thing that I think I went through this afternoon on that super point, right? And I went through a high growth fund, a balanced fund, a conservative fund, and basically it's not all private credit, but unlisted assets, private credit.
Often.
And infrastructure can be included in that, but I wouldn't mind arguing a lot of it's private credit, right? Because, see, they're being promised 7 and 8%, right? And so...
Well, let me read the somewhat of a definition for people that don't know what it is. So lending, listen to this. Lending done outside the regulated banking system, already a red flag. Lending done outside the regulated banking system, often through funds that pool retail and super money to lend to businesses, that businesses banks won't touch.
Yeah.
So that even in just a definition that's quite plain.
Mate, they're like pawn shops.
It's trust me, bros.
Yeah, literally.
They're basically like pawn shops.
107 back.
Yeah.
They're basically like, you take your guitar and you say, I need $100 till next Friday, and they're like, yeah, sure.
Loan shark.
But the main point I wanted to get across here was a couple of things. One is, like you said before, Tom, this has got like GFC written all over it again, right? Our Jacob and I spoke about it, I think, maybe last week, but it's gone from 35 billion to 250. Like it's exploded. If you look at finance, bros,
Is that globally or
no,
in Australia?
just in Australia.
Okay.
Yeah.
In the US, it's like up over trillion, 1.5,
okay.
maybe 2 trillion. But what I'm noticing is, again, my feed is coming through with so much stuff saying private credit. And the problem is it's backed by real estate assets, right? So they come to you and say, hey, Jacob, we can give you 8% paid monthly. You say, great. And they say, yeah, it's backed by, real estate. And the real estate's valued at 250, right? And then the next minute it's valued at 150. And this is what happened. What happened was there was I think it was this week, a guy came out who did wanted to create a hotel empire, right? Anyway, he's just gone belly up, right? But what he did was, and what they're doing is they buy a hotel for 250 million, they revalue it at 600, then they go and get, a loan against the valuation. So it's a little bit like what people are doing in their resi properties, right? You buy a property at $1 million, it's then 6 months later it's worth 1.2. So you go back to the bank and say, hey, I want to draw that 200 to buy another property, right? And this is what's going on. And the important part is we're getting into this situation where over the long cycle, and I'm talking 30 odd years, actually probably even 40, we're having these consistent banking scandals. Yeah. Right? Because it always comes back to the finance, right? It's always about money and debt. And what they did was, if I can just recall, there was an S&L scandal, right? Savings and loan in the US in about 87, right? That was when they deregulated in the early 80s, right? And the savings and loans, they used to be like credit unions, right? Very super conservative, personal loans, not mortgages. Then they could do mortgages. So what did they do? Exploded, right?
Well, in 87, it crashed, right?
That's right.
Yeah.
So they had to bail him out.
Yeah.
Then there was another one in early 90s in, I think it was Europe. Then there was the Asian financial crisis, which was in 97. Then you had the dot-com crash, right? Partly because of the high finance. Then you had the GFC, right, which was residential mortgage-backed securities and speculation. You've had a few of them through the 2010 to 2020, and now we've got this problem again, right? And it's all based on this problem of loading people up with enormous amounts of debt. And so what people are doing now, as we've been talking about, is they're speculating on leveraged ETFs, right? Like they're buying options, right? They're buying crypto stuff, right? They're all looking to get rich in one hit. And it's like we were talking before, which we haven't got to, situational awareness with, Lord Leopold, who, just as background, folks, situational awareness was a hedge fund who was run by a 25-year-old, and he was leveraged. He had 20 billion. Well, it was worth 40 billion. Then it blew up, and he had to sell it for half price because he got margin called. And the leverage was something like 400 times leverage.
Shouldn't laugh. That's other people's money.
It's ridiculous. But do you know what I mean? Like,
who's given a 25-year-old that much of their money to look after?
That's insane.
Yeah.
That's absolutely insane.
But
Blind Freddie could have seen that had red flags all over it. Is all AI stocks. He was an open AI guy, wasn't he?
What did he? Did he have what he had?
I think so. Yeah.
What did he have?
I don't know. It was
the fund is called situational
awareness. Yeah.
Right.
Full of AI stocks.
How do you lose money in an AI bull market?
But see,
hills,
SpaceX has blown up.
Yeah, true.
It's gone down a bit. But my point being, I just as a I think it's fair to say I'm an old timer now in markets. I just keep looking at it going, this is diluted. This is seriously diluted. I mean, it's just nuts. And the debt levels are absolutely through the roof.
Well, I mean, every empire has been crumbled off of debt, right? It overspends, gets into debt, goes to war, and then
it blows up. But that's what I'm saying, Jacob. Since we moved off, I'm no fan of the gold standard, and I won't bore everybody, but since 1975, we have just had consistent financial crises everywhere, right? Bloody Sweden, Korea, America, England, Australia, there's just this constant series of finances blowing up, and it's all because of speculation, debt, and leverage. and it just keeps rolling on. And my concern this time is that it's so big. This is why I think we're going to have a long, slow decline, because it's like Japan, right? The debt is so big, but if you went, well, bugger it, it'll just have to, we'll just have to let them go belly up. Mate, I'm telling you, the place will sink. Yeah. I don't know if you guys have been watching this week with residential property, but, you'd think the market was down 40% already.
Yeah, well, only from what I see on social media and stuff, it's every kind of property influencer and their dog saying, "Oh, I've got no one at my auctions, but this is the best time to buy because
yeah."
You're just like, mate, you need to go home. It was a long way to go.
But Jacob, it's
it hasn't even dropped in Brisbane, I don't think.
It's like
I checked recently.
Tom, I think it's down like 2 or 3% nationwide.
The top end in Sydney's come down a lot, but not necessarily come down a lot. People are just waiting. People don't know where.
There's no need to rush anymore. Yeah. Why would you rush into a property now when you're looking at it and the prices are sinking? Yeah. And this is why I say the narrative has flipped. Mm. Right, and the narrative is now, other than people in property, most people would be looking at it going, okay, well, there's no need to rush in and buy a property.
Yeah.
Now they're all revising, but
it's so sweet watching all these property influencers.
There's a bit of, what is it, Schneidenfraud or whatever the Germans say.
Well, it's just obvious that they're so incentivized. And they're so used to making so much money in a living. Yeah. These real estate agents and buyers agents, and now they're scrambling, and you're like, screw you. Honestly, you've just ripped people off for so long.
But by the same token, Jacob, I think again get it out, Steve. Part of the problem with being young and not being through cycles is you don't realise that they cycle. Yeah. Right. And, a lot of buyers agents are under 50. The reason partly for that is because there wasn't buyers agents before this cycle. Yeah. People went and go, oh, that's a nice home, and they'd buy it. They didn't need some bloody buyers agent to tell them it's a nice home, right? So there's that part of it. Like I was saying before with incentives, they just want to goddamn get someone to buy a property so they can make money, right? So the incentives are all pear-shaped. And so from that perspective, when you look at it, it's in nobody's interest, right? Like you were saying before, right? The old fella comes out and he goes, oh, the bloody no one up my auctions. I've had 6 auctions and, they've all been passed in. It's a disaster. But anyway, cycles turn and, it's a great time to buy. Yeah. It's sort of like, dude, that's, seriously, you can't do that, right?
Yeah, you wouldn't even call it a drop, especially in Brisbane. It's still up almost 6% this year.
It's like a flesh wound, Tom.
Yeah. And how do you even measure month to month? I think it says
in property.
It says here it's like .something% down for the month, but up 5.5 for the year. It's like, how do you gauge that?
I think overall,
stupid.
It's actually beneficial for young people, right? And I think there's 2 things or 3 things going on here. One is that over the next 5 or 10 years, everybody loves real estate because they think it's a way to make money, right?
Well, it has been.
Jacob, 100%.
A very good way.
Yeah. But when the game changes, that's when people go, you know what, I might invest in, stocks, right? Why? Because property is no longer the place to be.
Well, yeah, you got to pay stamp duty, you got to pay all these other costs. If it's not necessarily 100% going to go up, there's a big risk.
Absolutely.
Big monthly
bill.
I
think the other thing too, Tom, is that what we've been doing that for so long, that making money for so long, that it becomes an absolute shock to some people when it goes down, right? And that's why I say they're the people who haven't experienced cycles. And over the last 25 years, because Australians have been piling on in debt, what's happened is every time it's taken a dip, it's gone back up, right? So do you know what I mean? People go, oh, I don't know about this, and then it bounces. Oh, cool, no thing to worry about. Oh, I don't know about this. Oh, bounced as, oh, this is great. Hey, listen, property always goes up
till it becomes a dead cat.
Absolutely, absolutely.
And we've never really had like a systemic narrative change either. There's been COVID.
It's by the dip.
There's been 25 years of property will always go up.
No, these changes though, there's CGT changes and the incentives have shifted,
yes,
right?
100%. And I, you know, the incentives have shifted. The narrative's changed on a bloody dime.
And wait till rates go up again.
No, and rates, people can't loan as much. People can't lend as much.
Yeah.
Rates have gone up, and that there's all the incentives.
You mean people can't borrow as much?
Sorry, people can't borrow as much. It's my English.
You're still private credit mind.
Lending.
Where can I put my dollars this month?
It's the English. I would call it lending.
Yeah, no, that's true.
From the bank.
I was just wanted to clarify that because banks lend, people borrow. But anyway, we're getting semantic.
Backwards.
But yes, I know what you mean. See, immediately investors, particularly those that are savvy, have gone, right, that's it.
No, I'm done.
That's it. Yeah. We're not buying another property. End of story. In fact, we're going to sell the ones we've got.
Yeah.
Right. So
just before we start talking about the rule of 72, I just wanted to quickly touch finally on private credit.
Yeah.
Because I think we mentioned it last week or the week before, but so many people don't actually realize that their super funds have that.
Yes.
So like actually going in and having a look at your super fund,
100%.
What's exposed to private credit is so important. If anything, if you've been listening to us for any longer than a couple of months, go and have a look.
Yeah, absolutely.
It's a good shout.
Look, when you go into your super fund, you look at the investments. It's usually like asset allocation or something, and it'll be 25% Australian shares, 30% global international shares, 5% fixed income, unlisted assets, and alternatives. That's where you want to look. And my investigation yesterday turned up roughly about 30%. That's a lot.
Yeah, of course.
That's a lot. And the regulators, I think it was ASIC, if I remember correctly, ASIC have basically said, we're getting a bit concerned about this, right? But this is what I mean. It's, the regulators are sitting on their bum going, we're really concerned about this. And it's like, well, bloody well, get off your ass and do something about it.
Yeah,
start pumping people and saying to them, listen, you got to go and look at your super fund and, ask your super fund company, what am I invested in? What's the risk? Because according to the private credit people, the risks are like minimal.
Well, the problem is that
it's garbage.
Yeah, this is, to summarise, ASIC have put private credit under strict regulatory scrutiny, and basically warning that poor valuation practices, hidden bad loans, conflicts of interest, and heavy exposure to risky property development pose significant threats. So, but the reason being, you don't know what's in that package.
Yeah, it's a lucky dip.
It's like an ETF, but it just could be dog crap.
Absolutely.
Yeah. It's the same.
And the problem is, see, again, the incentives are that the companies are getting fees from the people who invest in it and getting fees from the developers paying back the loan.
Yeah, it's just cyclical.
But the valuation is dependent on the information being fed.
That's exactly
and that's
right.
being manipulated.
Yeah. And, the building industry's got a history of going bankrupt on, every time they build a development. So from that point of view, and this is, again, what I think ASIC said, or the report came out late last year, said this is a bit unusual because there's no delinquencies, right? And it's sort of like there's a lot of delinquencies in the building industry, but apparently none of these private credit guys have got any of these shitty developments. They must have all the good ones.
There's a lot of delinquents.
Yeah. Well, I suspect that's probably more like it, right?
And if super funds even have 10%, and they all go, and that domino fall, super funds are massively at risk.
But you imagine, Jacob, if that tanks and
the market
tanks.
If the market drops 50 and private credit goes, people's portfolio could drop like 70.
Your super fund will write to you and say, "Can you give us some money?"
There will be no.
Absolutely,
I'm fear mongering now.
Let's get the tinfoil hats. Have a look at private credit.
I'll take my 10.
And then in other news, rule of 72.
Yes.
Steve's age.
Thanks for that.
That was last year.
What I want to do here is just highlight I think there's a bit of a melt up going on, like the market's really going off, and the melt up phase is the last phase before the blow up, right? So I think, again, what I want to do is, blind people with mathematics and say, if you work out compounding, the current earnings yield on the US is 3.3, right? Let's say 3. Okay? So that means the rule of 72, right? 72 divided by 3, right? And that gives you the number of years it takes to double your money. Mm-hmm. Okay? 72 divided by 3 is roughly what? 24, right? So 24 years
Precisely
to double your money, right? Now, if you want to know triple, it's 115. Right, so you go 115. That's how long it takes for you. 115.
The rule of
divided by
115.
3 to triple your money.
Triple it.
Right, but I digress. So my point being, at the moment in the US, if you bought the S&P with an earnings yield of 3, it would take you 24 years to double. Mm-hmm. Right, if you waited and said, "I'm going to wait until 10." That would mean 72 divided by 10. It takes you 7.2 years to double your money, right? When the earnings yield is at 10. And what I try to get across to people is the point of saying, whilst it feels hard, you've got to take the Warren Buffett approach here, which is if you compound at 10%, you will be absolutely richer than somebody who can't wait but gets in at 3, right?
And dollar costs.
Yeah, again this argument where they say, you let time do the work, and it's like, no, that's garbage. It's the rate at which you compound.
Yeah.
Right? If you compound at 14.4, right, you double your money every 5. Right? If you compound at 3, you double your money every 24.
Yeah.
Well, I know which one I want.
With higher risk because the chance of a drawdown.
Absolutely. Absolutely.
Up, yeah.
Well, then you get those people that say just do 10% a month, and that's easy.
Yeah, yeah.
And you'll double your money every couple of years.
Yeah, buy an ETF, you get 10.
So this is why it's important that when you're thinking about investing, because when you get money, you want to do something with it. I was just thinking today, one of my relatives was at uni and then young, right, and got a really good job. Immediately bought a Jeep, right? Someone else I know,
Type 3.
yeah, someone else I know got a job, right? Had a self-employed job, right? Then got an outside job. Immediately went out and bought a Ford Bronco Ranger, right? 110 grand, right? Another guy I know, his father passed away and left him some money. He immediately went out and bought a $140,000 BMW, right, with every bell and whistle on it, right? Yeah. Now, he's a car enthusiast and he's got 3 motorbikes and he loves it. But my point being, when you get money, you immediately think,
What can I do with it?
What can I do with it? Even if you went, I've got 200 grand, I've got to invest it. That's fine. But my point being is, just because you get that money now doesn't mean now is a good time to invest.
Yeah,
right?
that's good advice.
And that's why the problem is when you go to a financial advisor, most of them are like, sure, yeah, no, 8% average. Yeah, give us the 200.
Yeah, now because it benefits me.
That's right. That's right. Whereas if you, again, know simple things like the rule of 72 and compounding, but importantly, you talk about the compound rate, not the time, right? Because if you say to people, hey, would you like to double your money in 24 years or in 5? People would go 5. And it's like, okay, now you got to wait.
Yeah.
Right?
And most people would probably say, do I have to wait 5 years?
Absolutely. Yeah. I could just buy crypto.
Yeah,
Double tomorrow.
You see 5 years.
Loser.
Yeah, I'll be old by then.
But it's true, right?
Yeah.
And so it's just when the market's exploding, right? As we were talking before off air, like, well one killed it this week, right? It's been going sideways for 6 weeks. Then it's like boom, right? And it's waiting for those times where the odds are in your favour, right? And the way you do that with compounding is say, what's the rate?
I was quite impressed with the well-worn client. So usually the chat's going off.
No, that's when it's not going up.
Yeah,
when it goes up,
no one's
crickets.
written to me. No one's written to us this week.
Oh, you might get it on separately, Stu.
Yeah. No. So, but anyway, there you go. So please remember that, folks, because it's really important because, as I said, there's a lot of debt out there. Things just look really, really dangerous. And it doesn't mean you can't invest, but it just means you've got to be active and know what you're invested in, right? Why you've invested. Have I got plenty of cash? Yes. Okay, good. If Woodside fell from 30 to 21, what would I do? I would buy more. Good, right? Rather than go, oh my God, I'd panic and, sell it. Or, it'd be really great, but I haven't got any money, right? There's that sort of stuff, right? You've got to walk through that plan.
That's good advice.
And I'll shut up now.
All right, we'll leave it there.
Thanks for listening.
Happy birthday, Mark.
Yeah.
Happy birthday, Mark.
To all marks.
All right. Thanks,
To all
guys.
marks. Cheers, folks.
You've been listening to Signals and Noise from Total Money Management AFSL 568642. This episode was general information and education only, not financial advice. It did not consider your personal objectives, financial situation, or needs. Any stocks, markets, or strategies mentioned were for illustration, not a recommendation to buy or sell. Past performance is not a reliable indicator of future performance. Consider your own circumstances and seek advice from a licensed advisor before making investment decisions.